Investing in dividend stocks can be a strategic choice for building a robust financial portfolio. These stocks not only provide a steady income stream through regular payouts, but they also offer long-term growth potential and stability. Whether you're navigating market volatility or seeking reliable returns, dividend-paying companies often demonstrate strong fundamentals, making them an essential component of a well-balanced investment strategy. Are you considering them for your portfolio? Here are 5 dividend stocks top analysts upgrade as a strong buy with a high upside potential. But before we get into the video, if you find any value in this, can you please click the like button and subscribe if you are new here? It really helps us. A friendly reminder, we are not financial advisors, so you should always do your own due diligence. Let's get straight to the stock. The first on our list is Amcor plc. Trading ticker is AMCR. Amcor is a leading global company specializing in sustainable packaging solutions. They offer a diverse range of flexible and rigid packaging products, including specialty cartons and closures, serving industries like food, beverage, pharmaceuticals, medical, and personal care worldwide. Amcor makes money primarily through the manufacture and sale of packaging products. Its revenue model is centered around key revenue streams, including the production of flexible packaging solutions, which account for a significant portion of its income. The company also generates revenue through its rigid packaging segment, which produces containers and closures for various end markets. Amcor's earnings are bolstered by strategic partnerships and long-term contracts with major global brands in the food, beverage, healthcare, and home and personal care industries. If we look at their financials, the income statement shows mixed results with a recent decline in revenue from the previous annual period and negative gross profit in the trailing 12 months. However, the company has maintained positive EBIT and net profit margins in both the trailing 12 months and the previous annual report. The revenue growth rate from 2023 to 2024 is negative, indicating a decrease in sales. The balance sheet reveals a stable equity position with a consistent equity ratio. The debt-to-equity ratio is relatively high, indicating significant leverage, but the company maintains a healthy equity base. Return on equity appears robust in the trailing 12 months period despite challenges in revenue. Cash flow analysis shows a strong operating cash flow outpacing net income, indicating effective cash management. Free cash flow remains positive with a stable growth rate over the periods analyzed. This underlines the company's ability to generate cash despite revenue fluctuations. To sum up, Amcor exhibits mixed financial performance with challenges in revenue growth and gross profit margins. Despite a high debt-to-equity ratio, the balance sheet remains stable. Strong cash flow supports operations, providing a buffer against revenue volatility. The earning call sentiment achieved a 4th consecutive quarter of sequential volume improvement, with overall volumes growing by 2.3%. They reported a return to sales growth with net sales of $3.2 billion, slightly ahead of last year. Adjusted EBIT and EPS both increased by 5% on a comparable basis. Progress on the merger with Berry Global is well advanced, with expected synergies of $650 million and significant cash EPS accretion of over 35%. They achieved an industry-leading total recordable incident rate of 0.30, with 79% of sites injury-free for more than a year. Generated an inflow of more than $350 million in cash flow in the second quarter, leading to a reduction in net debt by approximately $375 million. The earnings call presented a generally positive outlook with strong performance in volume improvements, EBIT and EPS growth, along with strategic progress in the merger with Berry Global. However, some challenges were noted in healthcare destocking and regional market softness. Overall, the positives were emphasized more than the negatives. During the Amcor fiscal year 2025 second quarter earnings call, the company reaffirmed its full-year guidance based on solid performance across key financial metrics. Amcor reported net sales of $3.2 billion, marking a slight increase from the previous year, with overall volumes growing by 2.3%. Adjusted EBIT and EPS both rose by 5% on a comparable basis, while the adjusted EBIT margin expanded by 40 basis points year over year. The call highlighted a total recordable incident rate of 0.30, with 79% of sites remaining injury-free for over a year, demonstrating a strong commitment to safety. Amcor emphasized the strategic merger with Berry Global, expected to deliver $650 million in total cost and financial synergies, with 40% realized in the first year. The merger aims to enhance margins, accelerate growth, and increase annual cash flows to over $3 billion. The company remains confident in achieving low to mid-single-digit organic growth, with a strong focus on innovation and sustainability. Looking at the dividends, the dividend yield stands at 5.48%. The dividend increased to 12.75 cents, reflecting a commitment to returning value to shareholders. The ex-dividend date is on February 26, 2025, and the payout ratio is 70.79%. On February 26, 2025, Amcor plc announced the commencement of consent solicitations from holders of various senior secured notes issued by Berry Global Inc., a subsidiary of Berry Global Group Inc. The solicitations aim to amend indentures governing these notes in connection with a planned merger where Berry will become a wholly owned subsidiary of Amcor. The proposed amendments include releasing certain guarantees and liens if Amcor provides an unconditional guarantee of Berry's payment obligations. The consent process is part of a broader strategy to align the credit support of Berry's notes with Amcor's notes, potentially impacting stakeholders by altering the security structure of these financial instruments. Volume growth returned in late fiscal quarter 4 of 2024 and continued in fiscal quarter 1, with a 2.3% year-over-year increase in fiscal quarter 2. The strategic merger with Berry Global is a potential catalyst for future growth, although current market conditions present challenges. 4 Wall Street analysts initiate a strong buy with a price target of $11.66, which is a 32% upside for the stock in a one-year forecast. Number 2 on our list is AES Corporation, with a ticker of AES. It's a global power generation and utility company headquartered in Arlington, Virginia. It operates power plants and utilities providing electricity to residential, commercial, industrial, and government sectors, as well as selling electricity on the wholesale market. AES uses diverse energy sources including coal, gas, hydro, wind, solar, biomass, and renewable technologies like energy storage and landfill gas. With a generation portfolio of approximately 31,459 megawatts, it operates in regions such as the Americas, Europe, and Asia. Established in 1981, the company changed its name to the AES Corporation in 2000. AES Corporation makes money primarily through the generation and sale of electricity. The company's key revenue streams include its regulated utilities and the sale of power through long-term contracts, power purchase agreements, and wholesale markets. AES operates power plants and sells electricity to residential, commercial, and industrial customers. The company also generates revenue from renewable energy projects, including wind, solar, and battery storage, which are often supported by government incentives and contracts with utility companies. Let's take a look at their financials. The company's revenue has shown a declining trend recently, with a 3.08% decrease from 2023 to 2024. Gross profit margin is high at 100% for 2024, indicating effective cost management relative to revenue, but this is likely due to misclassification of data. The net profit margin improved significantly from 1.97% in 2023 to 6.92% in 2024, showcasing improved profitability. However, the EBT and EBITDA margins have fallen, pointing to operational challenges. The debt-to-equity ratio is high at 1.70 in 2024, indicating significant leverage which can pose financial risks. The equity ratio is relatively stable at 34.23%, suggesting a moderate reliance on equity financing. Return on equity improved to 23.30% in 2024, demonstrating effective use of equity to generate profits, though it fluctuates due to varying net income. The company experienced negative free cash flow, worsening from negative $469 million in 2023 to negative $464 million in 2024, indicating substantial capital expenditures surpassing operating cash flow. The operating cash flow to net income ratio improved to 3.24 in 2024, suggesting better cash generation relative to net income. However, the cash flow situation remains challenging with high capital expenditure needs. To sum up, AES shows mixed financial performance with notable strengths in profitability and ROE improvement. However, declining revenue, high leverage, and negative free cash flow present significant concerns. The company needs to manage its capital expenditures and leverage to ensure sustainable growth and stability. Earnings call. AES achieved a record adjusted EPS of $2.14 in 2024, which is materially above their guidance range. AES signed 4.4 gigawatts of new power purchase agreements for renewables in 2024, and completed the construction or acquisition of 3 gigawatts of renewables. The construction of a 670-megawatt combined cycle gas plant in Panama has greatly increased the utilization of AES's existing LNG terminal in the country. AES has secured over 8.4 gigawatts of signed contracts in the U.S., with a significant portion having safe harbor protections. AES is also the largest provider of clean energy to corporations globally. AES plans to realize approximately $150 million in cost savings in 2025, increasing to over $300 million in 2026 due to organizational streamlining. AES Indiana and AES Ohio are executing a multi-year investment program leading to a rate-based growth of 20% in 2024. The earnings call reflects a balanced outlook with significant achievements in renewables and cost efficiency measures, countered by challenges in stock performance and weather-related impacts on financial results. During the AES Corporation's fourth quarter and full year 2024 financial review call, the company provided guidance for 2025, highlighting expected adjusted EBITDA between $2.65 billion and $2.85 billion, parent free cash flow of $1.15 billion to $1.25 billion, and adjusted EPS ranging from $2.10 to $2.26. The company anticipates over 60% year-over-year growth in renewables EBITDA in 2025, driven by the maturation of its renewable business and the addition of 3.2 gigawatts of renewable capacity. AES plans to focus on projects with higher risk-adjusted returns and to improve organizational efficiency, which includes realizing $150 million in cost savings in 2025, ramping up to over $300 million in 2026. The company aims to maintain its investment-grade credit ratings, eliminate the need for new equity issuance, and continue to pay dividends, with a long-term growth target of 5% to 7% for adjusted EBITDA through 2027. AES Corporation's dividend yield is 6.43%. The quarterly dividend per share is 17.5 cents and the payout ratio stands at 32.44%. The ex-dividend date is on May 1, 2025. Dividends stay intact, equity needs eliminated, and lower risk to the growth plan, alongside $300 million in new cost savings. The company maintains flexibility in their capital plan, which is viewed positively. Management presented a thoughtful, credible plan to manage significant policy uncertainty and high cost of equity capital. 8 analysts are giving the stock a strong buy rating with a price target of $15.80. That's a 44% upside for AES stock in the 12 months forecast. Number 3 is Brookfield Infrastructure Partners with ticker BIP. It's a global infrastructure company that owns and manages high-quality assets in utilities, transport, energy, and data infrastructure. It focuses on long-term, stable, cash-flow-generating assets with significant barriers to entry, providing essential services to both public and private sector clients worldwide. Brookfield Infrastructure primarily makes money through the ownership and operation of infrastructure assets that generate stable, long-term cash flows. The company's revenue model is based on several key streams: regulated and contracted revenue from utilities, transportation infrastructure such as toll roads and ports, energy infrastructure including pipelines and storage facilities, and data infrastructure assets like telecom towers and data centers. BIP benefits from long-term contracts and regulatory frameworks that provide predictable cash flows, often indexed to inflation, ensuring revenue stability. Additionally, Brookfield Infrastructure may engage in strategic partnerships and joint ventures to enhance asset value and expand its portfolio, further contributing to its earnings. The company's global diversification and focus on essential services provide resilience against economic fluctuations and support consistent financial performance. Let's see their financials. Brookfield Infrastructure has shown significant revenue growth over the years, with a notable increase from $6.6 billion in 2019 to $21 billion in 2024. Despite this, net income has been volatile, with a sharp decline in 2024. The gross profit margin has been relatively stable, around 25% in 2024. The EBT and EBITDA margins have been healthy, indicating strong operational performance, but the net profit margin is quite low, suggesting high interest or tax expenses. The company has a high debt-to-equity ratio, indicative of significant leverage, which is typical for the utilities industry but poses financial risk. The equity ratio has been declining, pointing to increased liabilities relative to assets. Return on equity has also decreased significantly in 2024 due to lower net income. Overall, the balance sheet reflects robust asset growth but also rising debt levels, which could affect financial flexibility. Operating cash flow has grown steadily, but free cash flow turned negative in 2024 due to substantial capital expenditures. The operating cash flow to net income ratio is strong, indicating effective cash generation from operations. However, the negative free cash flow poses a concern for covering future investments without additional debt. To sum up, Brookfield Infrastructure has shown strong revenue growth and operational performance. However, it faces challenges due to high leverage and recent negative free cash flow, which may impact its financial stability. Brookfield Infrastructure reported a 7% increase in funds from operations, or FFO, to $599 million for the third quarter of 2024, driven by new investments and organic growth. The transport segment achieved a notable 50% increase in FFO, attributed to acquisitions and strong volume growth across networks. Data segment FFO increased by 29% over the previous year, supported by new investments and the commissioning of additional capacity in the US and Europe. They completed $3 billion in non-recourse financings, extending maturities and reducing costs, including a significant reduction in interest expenses through refinancing efforts. Brookfield also closed the acquisition of 76,000 Indian telecom tower sites, making it the largest telecom tower operator in India and the second largest globally. They secured $600 million in capital recycling proceeds in the quarter, achieving a total of $2 billion for the year. The earnings call presented a generally positive outlook with strong financial performance and strategic achievements, particularly in the transport and data segments. However, challenges in the midstream segment and foreign exchange impacts were noted as areas of concern. In the third quarter of 2024, Brookfield Infrastructure Partners reported funds from operations of $599 million, marking a 7% increase from the previous year, bolstered by new investments and organic growth. The utilities segment achieved an FFO of $188 million, driven by inflation indexation and a $450 million capital commissioning. The transport segment saw a significant 50% FFO increase to $308 million, owing to strategic acquisitions and strong volume growth. Meanwhile, the midstream segment's FFO decreased to $147 million due to past capital recycling and higher interest costs, yet the underlying business remained robust. The data segment excelled with a 29% FFO increase, reaching $85 million, supported by new investments like the acquisition of retail colocation data centers. The company also reinforced its capital strategy by completing $3 billion in non-recourse financings, enhancing liquidity to $4.6 billion, and maintaining a strong balance sheet with no corporate debt maturities until 2027. Brookfield Infrastructure's dividend yield is 5.95%. And the quarterly dividend pay per share is 43 cents. The ex-dividend date is February 28, 2025. Positive factors for the company include funds from operations increasing by 7.8% quarter-over-quarter and 3.9% year-over-year. Volume growth visibility suggests potential for future expansion. 6 top analysts are giving the stock a strong buy rating and a price target of $43. This represents a 54% upside for the stock in the 12 months forecast. Number 4 on the list is Opera Limited, trading under the ticker OPRA. Headquartered in Oslo, Norway, it specializes in mobile and PC web browsers, offering products like Opera Mini, Opera for Android and iOS, Opera GX and Opera News, an AI-powered news service. It also provides cashback rewards through Defy, owns GameMaker Studio for game development, and operates GXC, a gaming portal. Additionally, Opera runs online marketing platforms such as Opera Ads and Opera Ads Manager. Founded in 1995, the company operates globally and is a subsidiary of Kunlun Tech Limited. Opera generates revenue through a combination of advertising, licensing, and partnerships. A significant portion of its income comes from search and advertising partnerships with major search engines like Google and Yandex, where Opera earns money based on the traffic it directs to these platforms. Additionally, Opera monetizes its user base by displaying ads within its browser and through its Opera News app. The company also earns licensing fees from its technology solutions, which are used by third-party companies. Furthermore, Opera's strategic investments and acquisitions in fintech and gaming sectors contribute to diversifying its revenue streams. Let's see their financials. Opera has demonstrated strong revenue growth over the past years, with a notable increase from $165.3 million in 2020 to $480.6 million in 2024, reflecting a compound annual growth rate. The gross profit margin is robust, consistently above 50%, indicating efficient cost management. However, net income has been volatile, with significant fluctuations, although it improved to $80.8 million in 2024. EBIT and EBITDA margins have also shown improvement, signaling enhanced operational efficiency. The balance sheet reveals a solid equity position with a high equity ratio consistently above 80%. Opera maintains low leverage with a debt-to-equity ratio near zero, reducing financial risk. Return on equity, or ROE, has improved, reflecting better profitability. However, occasional fluctuations in net income have impacted ROE consistency. Opera's cash flow statements indicate a positive trajectory in operating cash flow, supporting operational sustainability. Free cash flow has grown, demonstrating efficient capital expenditure management. The operating cash flow to net income ratio is healthy, but fluctuations in net income have impacted cash flow stability. Lastly, Opera shows robust revenue growth and operational efficiency, supported by a strong balance sheet with low leverage. However, income volatility needs attention to ensure continued financial stability. Year-over-year revenue growth accelerated from 17% in the first half of 2024 to 29% in Q4, beating the guidance by 800 basis points. Advertising revenue was $93 million in Q4, growing 38% year-over-year, driven by e-commerce opportunities within Opera ads. Users in Western markets grew by 3.5 million, with North America and Europe now representing almost 19% of the user base, up from 16% a year ago. Annualized ARPU grew 33% year-over-year to $1.98, marking the highest ARPU growth in 2 years. New versions of Opera GX and Opera One were released, featuring AI capabilities and revamped designs, contributing to user growth. The user base of Opera GX grew to 33.9 million MAUs, up 22% year-over-year. Adjusted EBITDA came in above the high end of the guidance range, at $33 million, or a 23% margin. The earnings call presented a strong positive sentiment, with significant revenue and user growth in high ARPU regions driven by successful product innovations and advertising revenue growth. Despite the increase in costs and marketing spend, the company achieved impressive financial performance, surpassing guidance and setting a positive outlook for 2025. During the Opera Limited fourth quarter 2024 earnings call, the company reported significant achievements and provided optimistic guidance for the future. Opera's revenue growth accelerated to 29% year-over-year in Q4, a notable increase from the 21% guidance, driven primarily by a 38% rise in advertising revenue. Search revenue also grew by 17% year-over-year. The adjusted EBITDA exceeded expectations at $33 million, representing a 23% margin. The company noted impressive user growth in high ARPU regions, with North America and Europe now comprising almost 19% of the user base, up from 16% the previous year. Opera's annualized ARPU increased by 33% to $1.98, marking the highest growth in 2 years. The company guided for continued revenue growth into Q1 2025, expecting a 29% year-over-year increase, with adjusted EBITDA projected between $28 million to $30 million. For the full year 2025, Opera anticipates revenue between $555 million and $570 million, with an adjusted EBITDA margin of 24%. The company also highlighted upcoming product innovations, particularly in AI, as key growth drivers moving forward. Opera's dividend yield is 5.59%. The semi-annual dividend pay per share for shareholders is 40 cents. Its payout ratio is 87.91%. The ex-dividend date is on January 6, 2025. 5 top analysts are giving Opera stock a strong buy rating and a price target of $26.40. It's a 90% upside for the stock's 12-month forecast. Last one on our list is Supergroup Trading ticker, SGHC. Supergroup Limited operates as an online sports betting and gaming operator. It offers Betway, an online sports betting brand, and Spin, a multi-brand online casino offering. The company is based in St. Peter Port, Guernsey. Supergroup, SGHC, generates revenue primarily through online betting and gaming activities. The company's key revenue streams include sportsbook and casino operations, where users place bets on various sporting events and engage in a variety of casino games respectively. Supergroup monetizes its platform by taking a percentage of the wagers placed by users, known as the hold. Additionally, the company may earn revenue from advertising partnerships and sponsorships with sports organizations. Its earnings are further supported by strategic partnerships with technology providers and gaming operators, which enhance the user experience and expand its market reach. Supergroup Financial. The company experienced fluctuating revenue growth with a recent decline, as seen with a drop from 2022 to 2023. Despite a consistent revenue increase over years, net profit margin has turned negative recently, indicating profitability challenges. However, the gross profit margin remains strong, suggesting potential for recovery if cost controls improve. The balance sheet shows a healthy equity position with a debt-to-equity ratio of 0.06 for 2023, indicating low reliance on debt financing. The equity ratio is solid, reflecting financial stability. However, the slight decline in stockholders' equity from previous years could be a risk factor if profitability does not improve. Cash flow analysis indicates strong operational cash generation, with a positive free cash flow despite declining from the previous year. The operating cash flow to net income ratio is high, reflecting efficient cash flow management. However, the decrease in free cash flow growth raises concerns about sustaining future investments. Conclusion: Super Group shows a mixed financial performance with strong cash flow management and a stable balance sheet countered by recent profitability issues. The company benefits from low leverage, but must address its declining net margins to enhance shareholder value and sustain growth. Total revenue ex the US reached an all-time high for 2024, growing 18% year-over-year to 1.66 billion euros. Adjusted EBITDA ex the US also set a full-year record, growing 53% year-over-year to 391 million euros. For Q4, total revenue ex the US was another all-time high, growing 38% year-over-year to 487 million euros. Adjusted EBITDA ex the US grew 152% year-over-year to 129 million euros, with a margin of 26%. Set new customer records with a new daily record of just under 2.2 million customers, and a new high for average unique monthly active customers of 5.3 million. US revenue in Q4 grew by 64% year-over-year to 14 million euros, with the focus solely on iGaming. Finished the quarter with 356 million euros in unrestricted cash and no debt, announced a special cash dividend of 15 cents per share, bringing the total dividend for the year to 25 cents per share. Super Group delivered strong financial results for 2024 with record-breaking revenue and EBITDA growth, particularly in the ex-US segment. The company also experienced significant customer engagement and positive momentum in its US iGaming strategy. Despite challenges in the German market and maintaining a high marketing spend, the overall performance and future outlook remain positive. During the call, Super Group provided robust guidance for 2025, building on a strong performance in 2024. The company expects its ex-US total revenue to grow over 10% year-over-year, reaching at least 1.83 billion euros, with adjusted EBITDA anticipated to be greater than 435 million euros, maintaining a margin of 24%. For its US operations, the company forecasts total revenue of around 85 million euros, with total investment reducing significantly to between 30 million and 35 million euros. Combining ex-US and US figures, this translates to over 1.9 billion euros in total revenue and at least 400 million euros in adjusted EBITDA, achieving a 21% combined margin, an improvement from 2024's 19.5%. The company's US strategy will focus solely on iGaming, and they aim for profitability by 2027. Additionally, they announced an increase in the quarterly dividend target to 4 cents per share, reflecting confidence in future growth. Super Group dividend yield is 4.48% and pays shareholders semi-annually 3.9 cents per share. The ex-dividend date is March 10, 2025. Top 5 analysts giving the stock a strong buy rating and price target of $10.60. It's 64% upside for the 12 months forecast. In conclusion, dividend stocks offer a unique combination of income stability and growth potential, making them an essential part of a well-rounded investment strategy. They provide reliable payouts, reinforce portfolio resilience, and can serve as a hedge against market volatility and inflation. By investing in dividend-paying companies, you not only secure consistent returns, but also build a foundation for long-term financial growth and security. Please share your thoughts about these 5 stocks. Which one do you want to add to your portfolio? Don't forget to subscribe to the channel so you don't miss out on any content like this. Thank you for watching, and see you in the next video.